Plug Power stock settled at exactly $3.78 per share as of the market close on Friday, May 22, 2026 at 4 p.m. Eastern Time, capping off a massive trading week marked by intense volatility and a jaw-dropping 21.5% weekly surge that caught the broader alternative energy market completely off guard. While everyday retail investors spent the final sessions of the week tracking headline tech giants, the smart institutional money was quietly shifting directly into alternative power infrastructure, triggering a volume breakout for Plug Power that reached over 71 million shares traded in a single session. This sudden injection of liquidity and aggressive buying pressure was not even sparked by a direct corporate announcement from the company itself, which is the exact nuance that the general trading public completely missed. Instead, the sudden upward structural movement was entirely driven by sympathetic tailwinds after an industrial peer secured a massive multi-billion-dollar contract to supply energy equipment to infrastructure systems supporting high-scale artificial intelligence operations. This cross-sector correlation exposes a massive gap between what the average investor expects from clean energy assets and the harsh operational reality of global infrastructure demands. The mainstream expectation for Plug Power stock has always been wrapped up in a highly idealized vision of clean commercial transport, localized green hydrogen production, and the traditional materials handling sector. For years, the retail narrative focused heavily on warehouses, forklifts, and distribution partnerships with big box giants. However, the reality driving the current market momentum is far more urgent and industrial. The global expansion of massive data networks and heavy load computing facilities has pushed classic electrical grids to their absolute breaking points, forcing large-scale tech enterprises to hunt for alternative on-site primary and backup infrastructure. When a major market peer recently validated this massive addressable market by inking a multi-gigawatt equipment delivery deal, Wall Street suddenly realized that hydrogen infrastructure is no longer just a distant climate initiative. It is actively transforming into a high-priority, zero-emission backup alternative for the infrastructure powering the next phase of global technology. This realization has forced institutional portfolio managers to aggressively reevaluate their positions on alternative power equities across the board. If you look at the landscape of modern retail trading, everyday market participants utilize a wide variety of tools to navigate these volatile microcap and midcap industrial assets. Thousands of independent retail investors are currently managing their equity positions via platforms like the Robinhood app, utilizing specific features such as Robinhood stock trading and Robinhood fractional shares to accumulate stakes in volatile alternative energy companies. At the same time, traders looking for broader cash management solutions and structured borrowing privileges tend to shift their capital toward the robust Robinhood investments ecosystem, often keeping an eye on Robinhood Crypto and Robinhood Cash Management to balance their broader risk parameters. On the more sophisticated end of the retail spectrum, active market participants frequently employ platforms like SoFi Invest to handle their ongoing asset allocations. These retail accounts balance their speculative exposure by shifting capital between active individual stock selection and automated instruments like a specific SoFi robo-advisor or broad market SoFi ETFs. Whether utilizing SoFi Investing for automated savings or engaging directly with the active market via the main SoFi trading platform, the influx of retail capital into clean energy infrastructure has created an underlying layer of market liquidity that accelerates massive daily price swings. This structural fragmentation of capital becomes even more apparent when analyzing how larger institutional desks execute their trades relative to everyday retail buyers. While a casual trader might execute a quick market order on a mobile application during a breakout, large-scale capital allocators utilize highly sophisticated systems like the Interactive Brokers platform to manage massive blocks of equity without completely distorting the local order book. Institutional traders rely heavily on advanced Interactive Brokers trading setups to analyze historical order flow, minimize execution friction, and optimize Interactive Brokers fees across diverse global markets. Managing a high-volume asset requires deep liquidity, which is why multi-million-dollar fund inflows often route directly through a specialized Interactive Brokers account to secure clean execution during heavy volume spikes. When a stock experiences a massive trading volume explosion, the data passing through these specialized platforms reveals a stark contrast between short-term retail speculation and long-term institutional accumulation. To truly understand why the recent price action matters, we have to look directly at the underlying financial reality of Plug Power stock, which has historically been a source of extreme friction for long-term equity holders. For multiple fiscal periods, the company faced severe operational headwinds, characterized by extensive capital burn, elevated production costs, and severe supply chain logjams that continually depressed its gross margins. The common consensus across standard investing sites was that the company would perpetually dilute its shareholder base just to maintain basic operational liquidity. However, the reality revealed in the recent first quarter earnings report painted a completely different fundamental picture, signaling what the executive leadership team describes as a structural inflection point. Net revenue for the first quarter climbed over 22% year-over-year to hit $163.5 million, comfortably beating consensus expectations. Far more importantly, the adjusted net loss per share narrowed significantly to just 0.08 cents, driven by an aggressive structural recovery in gross margins, which jumped from a negative 55% in the previous year to a vastly improved negative 13%. This steady fundamental stabilization is precisely why the broader alternative energy sector is undergoing a massive reputational shift among serious wealth management professionals. Investors utilizing premium institutional resources like Fidelity Investments are increasingly evaluating how clean energy infrastructure assets fit into diversified macro portfolios. Long-term wealth allocators frequently look past daily price charts to analyze specialized vehicles like Fidelity ETFs and Fidelity mutual funds via the main Fidelity Brokers interface, seeking assets that offer real structural recovery potential. For individuals managing retirement capital, routing long-term core equity exposure through structured vehicles like Fidelity IRAs or tracking real-time asset flows on the Fidelity mobile app provides a highly disciplined way to separate near-term market noise from genuine industrial transformations. When active market participants utilize a professional Fidelity trading platform to monitor high-volume infrastructure equities, they are looking for clear evidence that a company can successfully transition from capital consumption to self-sustaining cash generation. Let us look deeper into the expectation versus reality dynamic regarding the company's core commercial focus. The average observer still views this business as a pure-play equipment manufacturer that sells fuel cell components to a limited pool of commercial partners. The reality is that the management team has spent the last several quarters building out a fully integrated end-to-end green hydrogen infrastructure network that spans production, liquid storage, and regional distribution. By operating localized production facilities that convert water and renewable electricity into clean hydrogen fuel, the enterprise is trying to de-risk its entire supply chain and insulate its commercial customers from the volatile pricing of third-party energy procurement. This integrated approach is precisely why they allow them to maintain deep, multi-year supply arrangements with massive global distribution networks, ensuring that their industrial customers can reliably transition entire commercial transport fleets away from classic internal combustion setups without risking unexpected operational downtime. The broader macroeconomic environment has also added an intense layer of structural pressure to high-growth, capital-intensive industrial assets. Over the past 24 months, shifting interest rate expectations and persistent corporate credit tightening have made it exceptionally difficult for early-stage infrastructure enterprises to secure affordable capital. When macro conditions shift, speculatively valued companies are often the very first to see severe capital flight as investors retreat to defensive megacap cash flows like Apple stock or the relentless momentum of Nvidia stock. This massive divergence in asset allocation highlights why the standard retail perspective often fails during complex industrial cycles. While casual investors look at a rising chart and assume a business is entirely out of the woods, experienced portfolio managers analyzing structural risk factors on an individual brokerage or through an automated Schwab Intelligent portfolio setup recognize that sustained capital efficiency is the only metric that truly guarantees survival. Navigating these highly volatile market cycles successfully requires a sharp moving away from speculative hype and a strict, unyielding focus on actual corporate cash flows. The long-term viability of alternative power investments ultimately hinges on whether these businesses can scale up their physical infrastructure without trigger-happy financing rounds that continually wipe out existing equity holders. Many individuals managing an active online investment strategy or exploring advanced online investing options find themselves searching for professional investment help because the underlying mechanics of these clean energy operations are incredibly complex. When a retail participant shifts towards self-investing or decides to invest online via a standard intelligent portfolio, they are often forced to confront the harsh reality that industrial manufacturing requires massive upfront capital expenditure long before it yields predictable recurring revenue. This structural reality is exactly why the consensus view across major analytical networks remains highly cautious, even as near-term price momentum shows aggressive signs of a major cyclical turnaround. As we look ahead toward the remaining quarters of the year, several critical catalysts and structural risks will ultimately dictate whether the current upward trajectory can be sustained. The executive leadership team has explicitly stated that sequential revenue growth is expected to continue into the next fiscal period, supported by expanding equipment deliveries and the steady stabilization of internal fuel production costs. However, the enterprise still faces lingering legal challenges and ongoing regulatory oversight regarding past capital allocations and infrastructure timelines. If the operational reality of these massive engineering projects fails to match the highly optimistic targets laid out by corporate leadership, the stock could easily face another sharp round of institutional repricing. Conversely, if the enterprise successfully capitalizes on the unprecedented surge in data infrastructure power demands, the upside potential could catch short sellers completely off guard. Comment below how many shares of Plug Power stock you currently hold in your portfolio, and let me know if you believe alternative energy assets will successfully capture the data center market over the next 12 months. In summary, the recent trading activity surrounding Plug Power stock perfectly illustrates the continuous friction between short-term market expectations and long-term industrial reality. The stock is no longer trading purely on speculative environmental sentiment. It is moving based on tangible margin improvements, sequential revenue beats, and its evolving position within the global data infrastructure ecosystem. While the casual trading public remains hyper-focused on classic industrial use cases, the smart money is actively positioning for a major structural transformation in how global enterprises secure alternative primary power. To survive and thrive in this highly volatile segment of the market, investors must look past daily sentiment swings, ignore the prevailing retail hype, and maintain a rigorous analytical focus on actual execution, capital preservation, and structural margin expansion. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.